I think silver can go from, I'm calling for silver now. I'm jumping ahead probably, but I'm calling for silver to go to 200 this cycle, fall back, could fall back 50, 60, 70, 75% in the bust, and then go from there. So let's say it falls back to 50. You could go from 50 to 1,000 in the next cycle. Gold could fall, I'm calling for 7,000 gold this cycle, could fall back to 3,500, 50% retracement, or 4,000. And then, I'm calling for 20,000 next cycle, probably 2032 or 3, somewhere out there.
If gold merely matched the prior bull markets, would be 8,000 to 9,000, merely matching those bull markets. With these conditions out there, it wouldn't shock me to see gold at 10, 20,000.
Global financial markets are confronting severe structural imbalances as sovereign debt escalates and currency debasement accelerates worldwide. Investors face compounding systemic headwinds, forcing both institutional and retail capital to seek tangible safe havens. David Hunter, an experienced macroeconomic strategist, and Michaeloliver, a veteran momentum structural analyst, project an extraordinary supercycle across physical commodities. They outline that silver is positioned to surge to $200 during this primary run, before enduring a sharp 50 to 75% retracement down to $50, ultimately paving the way for an astounding climb toward $1,000 by the 2032 to 2033 cycle. Concurrently, gold is modeled to reach $7,000 in this phase, undergo a corrective drop toward $3,500 or $4,000, and later advance toward $20,000 in the ensuing economic era. These historic upside targets underscore an urgent institutional flight from vulnerable debt structures directly into authentic monetary security. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold is an alternative asset category. So when the house catches fire, all the money doesn't get burned up. The money flees. A lot of it flees, and it goes to alternative categories. But when you look at the gold miners and silver miners, they are vastly undervalued, but they're also tiny as an asset category. So it doesn't take much money fleeing the stock market to goose that wet bar of soap straight up, okay? So that's what I think we're beginning to see. Now, I'm not sure where I think gold is going to go. By the way, we can use that as a first metric, and therefore if gold's going up this amount, then maybe the miners will go up twice that amount, right? That's what that spread suggests. If you look at gold's history, the bull market peak in 1980, after a bear low in 1976 near 100, you went up to 850. It was an eightfold move. It took 3.5 years, okay? Then 2001 and 2, you had an eightfold move to 2011. Different duration, but also an eightfold bull market. We were only fourfold because our bear low was 1,050 in 2015. So we're only half as much up as the two prior bull markets on a percent basis. And yet we have these events that have been percolating on the sidelines that nobody's recognized. Government debt crisis globally. And suddenly, and the T-bonds, which used to compete with gold as an alternative, not being a place to be. So if gold merely matched the prior bull markets, it would be 8,000 to 9,000, merely matching those bull markets. With these conditions out there, it wouldn't shock me to see gold at 10, 20,000. I don't have a prediction on where gold's going, except to say it's at least going to do a ho-hum replication of the prior two bull markets. Eightfold, okay. Now, silver is the most explosive market I can think of right now in terms of upside potential. And we've been arguing this for a couple years. Silver's value to gold is off the page, low. Silver was stuck in a price range for 50 years with two highs at $50. In 1980, when silver was 50, gold was 850, okay? Gold right now is where? 4,600, let's say, versus 850. And yet silver's only trading $16. No, excuse me, it's about the 70, so $20 above its 1980 high. That's trivial. Look at copper, steel, lead, zinc charts going back to the 1980s. Most metals made highs around that time. They're trading at 4 times to 6 times where they were that number decades ago. How come silver's only trading a small percent above its 1980 high? Gold's 4.5 times, et cetera, et cetera. Silver made a mistake. Now, maybe it was arbitrarily done by intervention, manipulation. I think that's probably true. But that didn't work because silver broke those restraints late last year when it blew through 50. So it said no more. And I think if silver merely catches up to lead, zinc, steel, aluminum, gold, and they stood still, those markets stayed where they are now, silver could go up to $500 or so. It wouldn't shock me. And also, if you look at the money supply, M2, you go back to 1980 and see where M2 is now, how much more money has been printed. Factor that into the price of silver versus 1980, you come up with something like $500. That's a to be expected norm, in my view. It's not my target. I frankly think when a market has been overdone, either upside for too long and too high, and it collapses, like let's say .com did, 80% drop then, like 2000 to 2002 in .com, and yet .com was a true statement. It really did change our lives, and yet they collapsed 82%. Silver has been oppressed for 5 decades, okay? 50 years, 46 actually, okay. But if it's been an error, quite often when markets make errors, they overdo it in correction. In other words, if they're too low for too long, they don't just go to what might have been a norm, they overshoot it in an emotional burst, especially when you've got the situation now where there's no other alternatives. If the stock market starts now to break, the bond market's highly in question, where are you going to go? You get the point. It could be a wet bar of soap phenomenon for the miners and for silver versus gold.
When systemic panic strikes financial markets, capital flees conventional paper assets and rotates rapidly into alternative categories. Mining equities and physical bullion represent a microscopic fraction of global wealth, creating a violent liquidity squeeze whenever institutional money shifts direction. Looking at market history, major precious metals bull cycles regularly produce 8-fold expansions over multi-year periods, as witnessed from the mid-1970s into 1980, and again between 2001 and 2011. While primary base industrial commodities like copper, lead, and zinc have multiplied substantially above their historical benchmarks over several decades, silver has endured nearly 50 years of artificial price suppression. Whenever an asset remains compressed below fair value for extended durations, the inevitable resolution triggers an aggressive upside overcorrection that realigns valuation with broad money supply expansion. This structural imbalance leaves traditional markets unprepared for the sheer volume of wealth seeking physical sanctuary. Now, let's get back to the interview.
I can't get there myself to Michael's numbers, but I don't think he's crazy, and I certainly don't discount his experience and knowledge. And it's certainly possible it exceeds my expectations for this cycle. But right now, 200 is as high as I can get, and I raised it. I had it at 125, I think, going into January, and then raised it to 170, I think, and then raised it again to 200 at the end of May. So. But that's, I'm pretty confident with the 200. I just can't get to the 3, 4, 500s that Michael's talked about, and certainly not 1,000. The 1,000 for me is probably a 2032 or 3 type period. But you can drive a truck through how much you can miss that by. It could be 2 years either way. But if it's the next cycle really getting driven, and it comes from a lower level in the bust, I do think the metals will, as they always do, get hit in a big market correction, in a recession, or in this case is a bigger than recession type downturn. But those that are very turned off by the fact that silver got to 122 and rolled over and has been down for months, and it shook out a lot of weaker hands. As you know, because we've talked about this for years, I was bullish on silver and gold, 2, 3, 4 years ago, and it took a while to get going. Gold got going before silver, but silver, I took a lot of heat because when it was in the mid-20s and just couldn't get out of its own way. It was trade, and particularly the miners, but between mid-20s and the high teens, and then it got up to 30 and then backed off again. People just didn't believe that it had the kind of legs that I talked about. And then when it finally broke out and took off, that's when people jumped on the bandwagon. So they didn't buy it at 30 or 40. They bought it at, 60, 70, 80. And then they're really upset because they lost money. But that's markets. Once things get to a bullion, the market has a way of basically bringing back the discipline, shaking out the weak hands. And because the run from 50 to 122 was parabolic and happened so dramatically, it took months to correct. And I can say that looking back, I didn't know that it was going to take 6 or 8 months to get going, but I'm confident now that 55.6 level was the correction bottom, and that we have begun the turn. Obviously today it's coming out of a little bit of a pullback yesterday, and it looks like it can go higher. There's still going to be pullbacks. It's still going to be, you have to be careful with it. But I do think once it breaks above a certain level, and I'm not sure whether that's, I see 72 right now as the next stop, but I know Michael's probably talking higher than that. But there'll be corrections along the way, but I don't think they're going to be long lasting. They might last days, but not months. If you price gold in various currencies, you'll see differences in returns because the currency matters. Obviously, the dollar in the last year has been up, and yet gold had a nice run. So it hasn't been the case near term, but I do think the big move from 4,500, 4,500 here to 7,000. A lot of that is going to be currency. I mean, the dollar, I have the dollar going to 83, something like that, over the course of the next 6 or 9 months or less. And if that happens, it's a big part of the move to 7,000, I think. It's more than that, though. Obviously, rates coming down, which, as I said, I think rates peaked yesterday. And I don't usually try to call things to the day, and I didn't call it, but I don't usually pinpoint things like that. But it looks to me like you finally got to max pain, max bearishness, and then obviously what Besant announced today, helps. But I have rates going down from here for the next 18 months. It'll start gradually, but ultimately, like I said, you could get 10-year down to zero. And that first move down, let's say from, the 460, 70 area down below 4, I think is going to help gold. That'll be trading down well. The rates will be trading down well while gold's moving up and silver's moving up. And then I think you can get a faster move from there down to 3 or even below. That will be kind of that final move up towards those numbers. And as I said, I can only get to 7,000 on gold and 200 on silver, but it won't surprise me if those numbers prove conservative.
Navigating secular commodity expansions requires a clear understanding of market sentiment and cyclic psychology. Following explosive parabolic advances, aggressive pullbacks naturally occur to shake out late speculative leverage and reestablish institutional discipline across the sector. These prolonged corrective phases often frustrate short-term participants who enter near local highs. Yet they establish solid structural bottoms that support durable long-term advances. Beyond internal technical dynamics, broader macroeconomic forces serve as powerful catalysts for precious metals. A softening domestic currency and the exhaustion of upward pressure on benchmark sovereign debt yields create a highly favorable monetary environment for non-yielding commodities. As interest rates roll over from peak bearishness, the opportunity cost of holding physical bullion diminishes, accelerating institutional reallocation. Even though deep economic recessions typically spark temporary liquidity contractions across all asset classes, physical supply deficits and structural monetary tailwinds provide resilient support. Understanding the divergence between short-term paper fluctuations and fundamental physical scarcity remains key during turbulent macroeconomic cycles. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.